Good afternoon and welcome to this edition of Finweek Money Matters, the show that helps you manage your finances. I'm Nozi Pumbanjwa. My co-hosts are Marc Ashton, editor of Finweek, and Finweek journalist Christia van Heerden and Finweek.com editor. Coming up on the show today, we discuss how trillionaires might manage their money. We also answer some viewer questions. And lastly, we take a look at the barriers to entry for small and medium-sized enterprises. We do encourage you to call in with your investment and market-related questions. The number to dial is 011-384-0598. Remember that you can read more about these stories and many others in this week's edition of Finweek, which is on shelves from today. The magazine is also available digitally in English and Afrikaans via mysubs.co.za. Now, emerging market economies are struggling, and with South Africans increasingly feeling the pinch, Finweek thought it would be an interesting idea to ask the experts how their wealthier clients are approaching their money in 2014. Joining me today is Henry van de Venter. He's the head of business development at Access. Thank you so much for making the time to join us. Now, as I was telling Marc and Christia just before we went live, that I tried to type in trillionaire and I kept on thinking I got the spelling wrong, and it seems as if Google doesn't even recognize the term as yet. So I'm not quite certain who we're talking about today, but it's certainly none of us behind the desk today.
Well,
but
if you go to Google Zimbabwe, trillionaire is actually one of the most
popular dollar trillionaire, right? Okay, great. But let's start off with, let's talk about these uber rich people as against the super rich, which I'm sure are our billionaires that we have. What are they thinking about in light of the global economic climate that we're seeing now?
Well, from an investment strategy perspective, Nozi, it's actually a very interesting question, because what we find with most billionaires and trillionaires and the uber wealthy out there is that they have made their money in business. And if they want to create wealth, they know where they're going to reinvest. Whereas if it comes to an overall investment strategy, one of the overarching objectives is to make sure you never ever become poor again. It's more about securing lifestyles and managing risk in a way that makes sense. Which is why you can understand that so many of them are anxious about the current South African environment, because certainly we've seen a lot of volatility over the last few months. We don't expect to have plain sailing going into this year, maybe next year, for a variety of reasons. So by and large, if you look at the uber wealthy right now, it's a question of how do I ensure that I protect myself against risk and volatility and maybe still capitalize from the few opportunities that are still around.
So one of the obvious questions is, over the last couple of years, there's been this talk about an asset bubble that's being generated within the equity market, and we not so much the debate around the bubble, but the fact that markets have run really hard for the last 3 to 4 years. You're getting 19-20% per annum. That those returns are not sustainable over the long term. How are you advising or talking to your clients in terms of what are we going to be doing when we start normalizing in terms of returns?
Well, one of the most important things we need to do, and by the way, Marc, I agree with you completely when it comes to the fact that the next 3 or 4 years will be fundamentally different. In fact, if you look at the last 10, with the exception of 2008, they have been phenomenal. It's been pretty great going. So the first thing is we need to align our expectations, because the reality is it's not as if there are other asset classes out there in South Africa or around the world that are set to give us the phenomenal returns we've become accustomed to. So point number one, readjust your expectations. The world is set to shift going forward. Point number two, now more than ever, asset allocation and active asset allocation is becoming increasingly important. So it's no longer a question of sitting in equities for the long term, but making sure that you benefit from those pockets of returns in asset classes as they come along, and how adept you are at managing that process is said to be your key measure of success.
But how do you have that discussion? Because you get 19% for 3 or 4 years in a row, and then suddenly you say, but guys, 6 or 7% is more realistic. Do you not get pushback from your clients saying, well, maybe you're the wrong person to be managing my money then, if that's the expectation that you're setting?
Yeah, it's a good old greed gene, isn't it? If we always want more, and there always is a risk from an advice perspective to migrate towards those that make us the best promises, that best align the information with my expectation. Behavioral finance is something they call confirmation bias. I'll listen to information that confirms my own opinion, but anything to the contrary is obviously wrong, so I won't listen to that. So how do we apply this when it comes to advice and disappointing clients when it comes to aligning their investment portfolios? Well, I've always believed that the single most important foundation for any investment management relationship is honesty. And that's not only honesty with each other, it's honesty with yourself in terms of how realistic your expectations are. So when it comes to those conversations, you have to ask yourself as an investor, would I rather have somebody tell me what I want to hear, or am I going to be realistic, accept the fact that the world is going to change, and listen to how sound my financial advisor's strategy is when it comes to aligning my portfolio to that environment?
What are you telling clients then that have large exposure to emerging markets?
Well, by and large, if you're good at actively managing asset allocation, hopefully you won't need to have that discussion once a year or once every other year, and that's always such a danger. I mean, if you think of 2008, if you were seeing your financial advisor in June as opposed to in September, you would have had fundamentally different answers. So looking at those clients who manage their own portfolios, well, what you want to do on an ongoing basis, especially at times of uncertainty as this is you want to continuously adjust that asset allocation downwards, which in a way also then negates the question of, do you see the market crashing or gradually adjusting? Well, if asset allocation happened all along, and if you have been in emerging economies in the past, you want to see a gradual shift. And if that's not the case in your portfolio, well, maybe you want to rethink your portfolio management strategy altogether.
Yeah. I'm sure there's still money to be made somewhere, even with emerging market pressures. So whether it's within specific asset classes or specific markets, where can value still be realized?
Well, I was talking to Marc about this beforehand, and this has become such a really tough and challenging environment. Over the last 10 years, there were always great returns to be had elsewhere. And it was easy to identify value, it was easy to identify opportunity, and the markets were running based on sound fundamentals without emotion having too much of an impact. Where do we go right now? Well, the answer to this question will probably change every 2 weeks or so. But certainly in terms of our thinking, we are hesitant at the moment in terms of emerging economies, looking more towards old economies. And also one of the first investment lessons as an asset manager many decades ago that I was taught was, when your hairdresser tells you to buy something, yes, I did have a hairdresser, remember, it's probably the latest possible time to be selling it. So if you are going to rebalance your portfolio, and stuff like fixed interest locally starts making sense, and the interest rate cycle is turning, but what you want to think about is not what worked well in the last 3 to 6 months. That's always a bad basis for a decision. Rather ask yourself, over the period of my investment horizon, whether that be 5 or 10 years, where's the value? And then try and forget about the short-term blips.
Yeah, I mean, one of the questions we were chatting about off air a little bit is this idea about behavioral finance and sort of managing the expectations of clients. And one of the discussions that we had with a couple of the other asset managers and the financial planners was around small cap shares and taking bigger bets and riskier things, and feeling that I can take greater risk, because you keep telling, as an asset manager, you've said to me, but my expectations must start coming down. So therefore, I look and I see, well, some small cap has now doubled over the last couple of weeks. I want to be able to, I want a piece of that action. It almost seems to be a sense of boredom creeping in with some of the high net worth individuals. How do you cope with something like that?
Well, boredom always is a threat. But boredom and I guess loss aversion, we react twice as emotionally to losing money as we do to making money, and that's something to remember. If I am going to look at speculating, especially as a wealthy investor, if I've got R1 trillion, however many zeros those are, the first question I need to ask myself is, of my R1 trillion, how much money do I need to secure my lifestyle? Because that's always going to be boring 5-day test cricket. And once you understand of my R1 trillion, how much I need to secure that, whatever's left, well, those are your surplus assets, and you can afford to speculate with those. Because if you are going to speculate, to my mind, the single most important question you want to be asking yourself is, can I afford to lose this money? So if you want to speculate, by all means speculate, but first make sure that you secure that portion of your wealth that needs to make sure that you're never ever going to become poor again, and make sure you've got a sound, boring, active asset allocation strategy behind that to help you hit the returns you need at a level of risk that you can live with.
Okay, if you could give advice to someone who is not a high net worth individual, like me, like a very medium worth individual, in terms of asset allocation, what should our portfolios look like at the moment?
When it comes to investment strategy in broad, my point of departure is it should always be, if properly and responsibly managed, as aggressive as you feel comfortable with, provided that you've got the time. Because we must remember, when it comes to short-term asset behavior and long-term asset behavior, those are two very different pictures. I mean, my chances of losing money in the all-share index over this year or any other year is 1 in 4. But over 10 and 15-year periods, my odds of losing money become very minuscule indeed. So from an asset allocation perspective, I'm very hesitant of those rules of thumb that sort of take your age and subtract that from 100 and do an appropriate equity allocation on the back end of that. Rule of thumb would be, firstly, understand the return you need your assets to generate. Once you understand that, understand the range of returns that implies and the portfolio behavior that implies over the short term and the long term. And once you understand in a bad year what can happen, and if you're okay with that, try and go as aggressive as you are. And then one day, when you start drawing an income from your portfolio at retirement or possibly prior to that, then you can start looking at maybe being a little bit more conservative to balance out a lot of the volatility risk entailed in drawing an income out of a market-based portfolio. I haven't answered your questions at all, but especially prior to drawing an income, as aggressive as you can, but don't be reckless.
If we were to look at broader economic market data, I mean, oftentimes that people say that if you're playing on the stock exchange, don't look at what the economy broadly is doing and don't listen to analysis about the economy. These are two very different worlds that aren't always aligned and are not always mirror reflections of each other. But it's quite difficult to do that at a time where, there's a lot of talk about the impact of not only QE, but China becomes another factor. A person who's a trillionaire or potential trillionaire, if there are economic market data indicators they should be looking at, which ones are those? If you can't look at everything, but what should you be tracking right now?
Well, in behavioral finance, there's something called framing. It's basically the context and the window through which you look at information. So my point of departure when it comes to what information do I look at would be, firstly, make sure it's aligned with your investment period. So if, for example, I'm going to need this money or invest with this money for the next 20 or 30 years, make sure the information I track is appropriate. Sure, you need to have a sound global economic outlook. But always also remember that it makes sense to predominantly invest in the currency you're going to spend. So if I'm going to be spending South African rands or US dollars, I want my macroeconomic outlooks to align to that currency and the time frame within that economy that makes sense. So for example, equities in South Africa for a 24-month investors right now, not too sure. For a 24-year investor, it's a no-brainer. Your asset allocation won't change very much at all.
So do you see the picture getting better? Sorry, Marc, I just jumped in there. Do you think that we're seeing the last of currency volatility in the short term for emerging markets, and that it would be a good idea to stick with some of these emerging market currencies?
That's a very topical question. And I'm sure I'm not the first person to answer that question by saying that emerging market currency volatility has always been with us. This year especially, it's probably set to get worse than it was in recent history. We are going to an election year. We are seeing the impact of fiscal tapering on emerging markets and a number of other considerations. And right now, certainly there is a lot of argument to support the rand maybe being slightly undervalued. So if I'm going to invest in a currency and look at currency, the question I should rather be asking is, what is my long-term call on that currency, and stick to that framework, because over time, your currency is going to depreciate roughly in line with the difference in inflation, the inflation rate differential between our economy and the economy of the other currency you're looking at. Prior to this year, 18 months or so ago, the average depreciation of the rand against the dollar was about 5.5% per annum. And long-term, if inflation rates stay steady, and of course after the budget, we know in South Africa they will, rather stick to that average. And when the blips happen, and they are going to happen, forget about it. Accept long-term what's going to happen, and it will even out to give you that result.
So I guess in one of the questions around currency, and I know it's putting you on the spot a little bit from it, but what currency what constitutes a hard currency then? If you're talking to your clients, do we base it on a dollar exposure, or do we carry on taking emerging market exposure? How do you position it from an allocation toward currency perspective in terms of assets?
Boy, you see, you're going to put me on the spot, and you certainly did. What I won't give you is a straight answer, but let's look at the principle behind this thing. Investing successfully is about understanding pockets of value when they happen and being able to profit from those pockets of value. So when something is cheap, buy it. When something is expensive, sell it. And the great thing about the investment environment today is that you can make use of currency overlay. So I can buy the US market in rands, for example. It is no longer necessary to peg yourself to a currency based on the economy you want to invest in. And that means that in the short term, especially if there are drastic pockets of over or undervaluation in emerging market currencies, and we will find them, over the next year or two. Look at the currencies in isolation and sure, hedge where you can, but don't be reckless because currencies are hugely volatile, hugely emotional. What does that mean in South African context? Well, is this the right time to be buying the dollar? Well, a year ago, it would have been a very simple discussion. Now, maybe the converse would apply.
What about cash in the role of your, from an asset allocation perspective, South African rand denominated cash? What's the role of that in a portfolio at the moment? The one argument being that if you keep cash aside and there is a sharp pullback, you'll have some so-called dry powder to be able to profit from those. Do you believe that cash still has a role to play in a high net worth individual's investment portfolio?
Well, firstly, from a matching perspective, it makes sense. So if I know I am going to buy a new yacht or a new private jet, I know one of us was saying before, and we were looking at doing that next year. I won't say who. Then sure, I mean, it makes no sense to put your money in an investment vehicle or in an asset class that will be volatile in the short term. So matching it in the short term does make sense. Over the long term, let's look at the dry powder argument. If you're going to be good and effective at actively managing your asset allocation, you actually don't really need that dry powder because slowly you're moving the powder across as those opportunities come up. So does that mean that being in cash right now is a bit of a dead waste? Well, let's face it, interest rates are going up, but we certainly don't expect them, to in the short term at least go back to 1990s type odd levels. Rather, take a long-term view on an asset class and get your exposure and ignore the short-term movements and you'll be fine. And save yourself a lot of stress and get some extra sleep in the process.
Maybe I'll take the spotlight off you for a moment and maybe turn around and say, you're talking to your clients regularly, they're obviously high net worth individuals and they understand what's happening in the South African and international business context. What's worrying them at the moment in terms of their strategy and the outlook for 2014?
Well, aside from the short-term concerns, you spoke about the currency, we spoke about the local economy. Really one of the challenges is, as we mentioned earlier on, historically it used to be much easier to move your money elsewhere to sustain higher portfolio returns. And right now the question clients are asking, and in fact they're not alone, investment managers are asking the same question, is where do I go to sustain strong returns? Because the reality is that's become a very tough question to answer. Certainly it's almost impossible to answer decidedly in the short term. And on the back end of that, if I am coming off high valuations, and let's look at the South African index and stock market and a number of similar economies, we're coming off a high base. How do I protect myself against that? And for the first time in ages, on the back end of that, something like the bond market is starting to look attractive again. So right now, to summarize, if I'm going to invest my money, I can try and focus on one of two things. Either to try and get the highest returns I can, or to get the returns I need with as little risk as possible. And the latter strategy right now is making a great deal of sense. And that is the question that more sophisticated investors are starting to ask.
Henry, before we let you go, very quickly, if one was a very high net worth individual and they have some excess funds and they just wanted to play a little, which areas would you say, even if they were really high risk, could be explosively profitable? If you had a couple of $100 million to throw around, where would that be if you could play with that?
I was saying to Mark earlier on, watch me use 5 years of law school to artfully dodge questions. and I shall now attempt to do that. If you really are going to speculate and make emotional bets, your options as far as that concern change on almost an ongoing basis. Certainly if we look at more sophisticated investors, aside from having a wealth preservation strategy, they tend to have a private share or discretionary share portfolios, often including derivatives and all the rest. Where does your stockbroker fit in? Those guys that will advise you on sort of where to speculate and the weird and wonderful things to do. Well, it sort of fits into that part of the picture, your surplus capital. And as far as those opportunities are concerned, they always abound. But if you're really wealthy, if you really want to make money, the reason why you're wealthy is because you're very good at what you're doing. Probably be best off by reinvesting it in your business.
I mean, I think Henry made an interesting point just before off air was the worst thing that could possibly happen is that you speculate and make some money, because I think that what happens then is you end up taking the bets, they get bigger and bigger. It's quite an interesting, it comes down to behavioral finance, which I think has been a theme that we've been carrying through for the last couple of weeks.
Very much so. And in fact, even if you are going to take a chance with a pocket, if that works, the question we start asking is, but hang on, why don't I do that for all of my money? And on that road lays financial ruin. That is the simple bottom line. And if you're going to be greedy about it, and if you want to take food off the table when there's none to be had, it's probably not going to end up well for you, regardless of how wealthy you are.
Well, suffice to remind us that none of us around this desk are trillionaires or multi-dollar millionaires or billionaires for that matter. Henry, thank you though for making the time to join us. That's Henry van der Venter, Head of Business Development at Axis. Time now for a quick look at our Finweek Trade of the Week. This week's Trade of the Week is the French CAC 40. Now, Marc, doing a little bit of research on the CAC 40, realizing that this index has broken through some resistance levels last week. Where do you stand on it?
I guess I've been shorting it I've shorted it a couple of times successfully this year, and what's happened is that, and that's sort of been around the 4,200 mark. It's now moved up to about 4,400 points. And I've gone short again on it. And the reason is very simple, is that the CAC 40 is very much a luxury goods focused industry and has a lot of exposure to China. If you believe that the argument that the Chinese market is slowing down, they are going to be hit quite hard. They're going to feel it quite intensely. Remember, France has got a lot of labour issues at the moment. The wealth taxes that are coming through, I mean, they're talking sort of 70% tax on high net worth individuals. It seems to be pretty much everything that they can possibly do to penalise high net worth individuals is being done in France at the moment. If you run businesses, it's hard. If you make money in your personal capacity, it's hard. There's no real drive. It's not an index. If you look, for instance, like the DAX, the German index, which is basically an industrial index, CAC is very much luxury goods. It's very much top end, and it just looks expensive at the moment. So I would expect a pullback.
If we take the domestic factors aside and go back to the Chinese factor that you put out right up front, 7.5% growth, surely that's still much better than what you'd see in many markets, even if it's slower.
Sure. Look, I mean, there's a couple of arguments there. One, do you believe 7.5%? And maybe do, maybe don't. I think what you're seeing at the moment, there's a lot of concerns around corporate default within China, and even if in the bigger picture, a couple of corporate defaults is not the worst thing that can happen there. And I think you can see Chinese authorities desperately trying to let the air out of the balloon as quickly as gently as possible. But what's happening, you see more and more people saying, we almost had a default on 31st of January with one of those big high net worth products that they had created there. And the discussion is just being had that this is now an expensive market and something's going to happen, and rather let it bleed out slowly than suddenly have a big bursting.
Regional factors, are you also influenced to some extent by what's happening in the Eurozone, especially in light of the sluggish recovery there?
I mean, the question is what recovery? I mean, there hasn't been a real recovery in France, and you go in the headlines today. I mean, Qantas in Australia is laying off 5,000 people, and we're reading the same headline sitting next to it saying that we're having some economic recovery. The companies aren't seeing that. RBS in Scotland is shrinking by 30,000 people.
7.5% down yesterday.
Yeah, there's a lot of concerns that are in the market at the moment. So I think you've got to be I'm more to the negative side than the positive.
Marc Ashton, going short there on the CAC 40. Well, it's time for us to pay our bills. We'll be right back after this short break. But before we do, some of us, like I said, the trillionaires around the desk, will be paying more than just bills. So there is a little bit of excess cash lying around. It's time now to touch in with you at home with your questions that you've sent us via Twitter, via Facebook, and via email that you've sent through to Finweek and also to CNBC Africa. Well, the first question relates to politics, and as always, the world of economics and politics are always intertwined. And this question goes to Marc. The question is, do you have any concerns about the EFF manifesto? What do you think its possible effects on the South African economy could be?
Okay, so disclaimer up front, I'm voting EFF this year, so...
Oh, okay, great. So your vote is not your secret, but anyway.
My vote is not my secret, yeah. I've been quite vocal about the fact that I would support... Look, I mean, EFF manifesto...
So you have the... You've got the
No,
beret.
they won't. I'm still waiting for them to sell me one. But
Okay.
anyway, I will have one before the 7th of May rolls around. Yeah, I mean, look, I think that there's a lot of the EFF thrives on populist comment, and I think that it thrives on this idea that they're going to nationalise banks, they're going to nationalise farms, etc., etc. Reality is, EFF is not going to. The EFF manifesto is sweet, it's nice to have, etc. It's not going to influence economic policy in South Africa. And I think that I think there are some interesting things. I think there are a lot of serious discussions that need to take place around wealth redistribution, land distribution. I think there are a lot of issues floating around there that are not being tackled at the moment. But it's an interesting manifesto just because it happens to be populist, and it does reflect some of the concerns that are happening in the South African economy. But in terms of the actual manifesto itself, it's really it's a document that's interesting to look at.
It seems like it's really latched onto some of the peripheral issues. I mean, what's stuck out for me was the isolation of 12,500 rands for all miners and a minimum wage of 4,500. It sounds as if the manifesto is just playing on the frills, playing on the emotive issues, but there's nothing really there.
No, I don't think there's anything there. I think what you're essentially seeing is 12,500. Where did that number come from? That's come from whatever the miners were asking